Aligned for Success, a guide to what investors look for in a startup. Startup investors are not benevolent creatures. They are looking for certain signals that help to pursue them to part with their money. This video intends to help startups understand the key areas to focus on and empathize with raising money. Show me an entrepreneur and I will show you someone looking for money. While it may be hard to gain a trustful base, it seems to be even harder to find someone to invest in it. Business founders are continually looking for the right connections, be it the right networking contact or the third party with credibility that can introduce them to the right person who has money burning a hole in their pocket. However, at the end of the day, it's less about who you know and more about who you have got. Startups need to know how to attract investors if they want to get funded by them. In this video, we have pulled a discussion of the key items investors look for when making an investment decisions and some ideas on where to look for financing. Passionate founders means passionate investors. Having a passion for your startup is pretty easy to come by as a business founder. You believe in the product that you have and that you want to provide. You are confident that it is an important improvement over existing products or is a new way to address an old problem. In other words, being better than competition. But how deep is your passion? Are you willing to be told no over and over again, yet still keep going? While most investors want and appreciate passionate entrepreneurs, they are also looking for someone willing to invest their own money. As a founder, you will have to raise the initial capital yourself. You can do this from your own savings, borrowings, family, friend, etc. But you must be willing to demonstrate that you believe in product enough to invest your own money. You will have to get the business off the ground on your own. Significant market size. Most investors are looking for a business opportunity with growth potential. Accordingly, if your market is only 25 miles or kilometers around your headquarters, your growth is limited. You need to have a market with significant reach, at least regionally, depending upon the nature of your product. If you are selling surfboards, you clearly only have a regional market along the coastlines. But given the total market for surfboards, that may be sufficient. Not every product is going to have a worldwide market like phones or computers. However, a large enough market where the economics of scale can be incorporated into your operations to increase margins and profits will be needed to attract investors. If the product is not new but a new entrant to an existing market, the same issue holds. However, it is assumed that any market share you attain is coming from some other competitor. Thus, your competitive advantage must be demonstrable. Product differentiation and competitive advantage. This is going to be a critical issue for investors. What makes your product or service unique? There has to be something about your product that sets it apart. If you have a never-before-seen product and you're first to the market, that may be it. However, most startups are entering existing marketplace. What then makes you different apart from others? Team members and delegation. In an effort to save cost, most startups have very limited staff opportunities, often only 1 or 2 founders of the operation. Whether a business has 1 or 10 employees isn't so much the issue. It's whether or not the business has sufficient key employees covering the most important areas. For example, if your business is developing next use for blockchain technology, do you have someone on the staff that is an expert in blockchain? You must have an expert in the technology or market you are entering. Another idea is operating control. Investors want to know that you or your staff have developed operating policies and procedures to control the business and ensure their investment is not wasted. Your business has to have moved beyond the fake it before you make it phase, or investors will not have confidence that your company is a real business. And as the founder, have your delegated authority to the expert. No person has all the skills necessary to run a business successfully. However, Founders of businesses are more like parents when it comes to their business. The founder often tries to be the jack of all trades and centralize the control with themselves. Investors find comfort in a business that has a team in place, where team members have expertise and have been given enough authority to oversee their area of operation. Exit strategy. Investors have two primary financial questions about projects. How much do I need to invest and when do I have to invest? And the second, how much will I get back and when will I get it? Both of these questions can be answered by a thorough financial projection. The type of projections that investors want to see includes a complete description of the assumptions behind the model, a complete set of pro forma financials, income statement, balance sheet, and statement of cash flow, a return on investment analysis using capital budgeting techniques and various return on investment calculations, sensitivity analysis around key variables, and cash sources and uses report. It is recommended that such model is going to be prepared with monthly level detail, as this allows for monthly cash shortfalls to be identified. Preparing models with annual integrity can mask these details and potentially underestimate the cash investment required. Investors do not like it when you have to come back for more money because you have underestimated the need in your modeling. Essentially, investors want to know when they will begin to see a return and how large a return they can expect. Including a capital budgeting analysis and a full return on investment analysis will address these concerns. Often, it's not prudent for a startup to hire a full-time financial analyst in its early stages. It's far more effective to bring in experts who can assist with building out a financial model and pass on the best practices to the founding team. The X factor. Have you ever sat next to someone on a train and when the conversation starts you find that you have very little in common professionally or socially, but for some reason you just seem to connect? That is the X factor. Sometimes when you meet with investors, there's a connection that you cannot explain. You cannot plan for the X factor and you can't seek it. However, if you find that exists, it will benefit you. The best way to find out if the X factor exists is to be authentic in your presentation. Don't be uber professional, be you, be the entrepreneur who has an idea that can socially benefit and or financially benefit. Talk with the investors, not to them, and listen to them. The questions they ask and the comments they make will tell you what they find important. Listening will also lead to the identification of those things that signal whether or not the X factor exists. Where to look for financing. So, you are a business founder passionate about your product, who has skin in the game in a market space that allows for significant growth opportunity, with a definable competitive advantage and an expert team in place, with the authority necessary to execute the business and a defined exit plan. Where do you find someone to finance your business? Angel investors. Unlike venture capitalists who typically raise funding from other investors, angel investors usually invest their own money. Like most investors, angels have specific types of firms that interest them. One good way to find potential angels is to review a database, such as Angel Investment Network. Angel investors often invest smaller amounts, usually between $25,000 to $100,000 range. So depending upon the amount of funding you need, you might need to identify more than one investor. Angel investors are often one-time investors that help you get off the ground. They will be looking for an exit strategy, either throughout an initial public offering or if you obtain growth funding from another round of equity offerings. Venture capitalists, VCs for short, often invests significant amounts of money. In 2017, the median deal size was $18.7 million. VCs often take an active role in the management and guidance of the company. What do venture capitalists look for? Well, ultimately, VCs will be looking for an opportunity to exit their investment within a defined period of time, often by initial public offering. Crowdfunding. Historically, only accredited investors could buy stocks in privately held companies. Accredited investors are, essentially, high net worth individuals with significant experience in investing areas. However, in 2012, US President Barack Obama signed the Jumpstart Our Business Startups, Jobs for short, Act into law, having fully implemented in 2016. This law allows for non-accredited investors to purchase stock, provided that they do so through an approved crowdfunder like Start Engine 1. Many startups have expressed that using crowdfunding was a good alternative to traditional methods of fundraising. Debt financing. Obtaining equity finances will often require founders to give up a portion of their equity in startup. Sometimes an investor will require a majority stake and the right to appoint board members. To some founders of startup, this isn't acceptable. In such instances, it might be preferable to pursue debt financing. Many startups are actually funded by the borrowings with founders who can borrow money using their personal credit. This may come in a form of using personal credit cards or borrowing on personal loans. We will have more detailed video about bank loans in the future. Be selective. Whether you're looking for an angel investor, VC or a bank lending, find the investor that has invested in projects like yours. Look for investors with a history of investing the amount of money you are seeking. Never use a shotgun approach and sending a financial request to everyone you identify. Choose carefully, specifically, and wisely. Make it clear that you contacted the investor for a reason, other than because you need money. Networking. Once you have identified potential investors, it is always a good idea to try and find a connection to the firm. Investors receive many unsolicited investment pitches, and sometimes the connection happens, but it's always good to be introduced by mutual connections. In your networking, look for personal contacts that you have with the firm, whether it be from professional associations, social organizations, or even old college roommates. Identify a contact with the investor and then see if you have mutual contacts on networking sites. Be prepared to talk about your business. Have an elevator speech ready. If someone were to ask you to describe your business and your need for financing in 30 seconds, prepare this speech and practice it. Be ready to give it at a moment's notice. Give investors a way to find you. Even in this era of digital communications, business cards can come in handy. However, while the front has contact information, use the back of the card to present bullet points about your business, and be sure to provide a web address. However, don't give them the link to the homepage. Give them a link to an investor-oriented landing page. Make them feel like they have been given access to the back of the house and are not expected to come to you by front door like everyone else does. Whenever you have a discussion about your business, give a business card. Maybe the person you give the card is not an investor, but they may be passed it to someone they know. Summary. What investors look for in a startup? In the end, getting a business funded is less about connections, as much as it is about having a fundable project. Yet, the question of how to get investors can be summarized by whether your startup can offer them. It will take some research to find the right type of investors who will invest the right amount of money with acceptable terms. It may take a little time, but if you believe in what you're doing, keep looking until you find your yes. Thank you for watching this video. Hopefully, we helped you in finding the right investing for your startup. See you next time.